There is a market in the global financial system that most people have never heard of, yet it quietly dictates the fate of banks, governments, corporations, and currencies. It is the derivatives market, a sprawling network of financial contracts now valued at over 600 trillion. It is so large that it is more than 6 times the size of the entire world economy. Warren Buffett warned in 2003 that derivatives were financial weapons of mass destruction. At the time, many dismissed the statement as dramatic, but the collapse of Lehman Brothers and the bailout of AIG proved he was correct. A derivative is a contract whose value comes from something else. That something else could be a stock, a bond, a currency, an interest rate, or the price of oil. The derivative is not the asset itself, but a bet on how that asset will change. The derivative allows a person to profit without owning the underlying asset. It is financial speculation detached from physical reality. In simple terms, it is like betting on whether your neighbor Atreus' house will burn down and collecting money if it does. Some derivatives serve useful purposes. A farmer uses futures to lock in crop prices. Airlines hedge fuel costs to avoid sudden price spikes. These are rational, limited hedges that protect businesses from volatility. But this is not where this $600 trillion comes from. The overwhelming majority of derivatives today are used by banks speculating with leverage. They bet on interest rates, currencies, credit defaults, corporate debt, and sovereign debt, often with borrowed money. The key to understanding the danger is leverage. A bank can control a $200 million derivatives position while only posting $2 million as collateral. If the market moves just slightly against the bank, that collateral can vanish instantly. This means a 1 to 2% move in financial markets can trigger losses that wipe out entire institutions. And when one institution fails to pay its derivative obligations, those losses spread instantly to every counterparty connected to it. This is what turns a local problem into a global crisis. The most dramatic example of this system failing was 2008. The crisis did not start with derivatives. It began with subprime mortgages sold to households that could not afford them. But the mortgages alone were not large enough to collapse the financial system. The disaster came when banks packaged those mortgages into securities and then layered derivatives on top of those securities. The losses were amplified, multiplied, and spread globally. Credit default swaps allowed investors to bet on mortgage failures without owning any mortgages. When the housing market declined, these bets turned toxic. Companies owed payouts that were far greater than the capital they held. Lehman Brothers collapsed under this pressure. On paper, it appeared solvent, but hidden in footnotes was over $35 trillion in derivative exposure. When the value of its bets moved against it, Lehman could not produce the collateral needed to stay afloat. Once Lehman fell, every institution tied to Lehman through derivatives suddenly faced losses. Banks stopped trusting each other. Lending froze. Markets seized. Confidence disappeared. Then AIG collapsed. AIG had sold hundreds of billions of dollars in credit default swaps but had not set aside capital to cover losses. When mortgages defaulted, AIG owed more money than it had. The US government stepped in with $180 billion to keep AIG from collapsing. But the bailout wasn't to save AIG. It was to prevent the failure of every bank that had purchased derivative contracts from AIG. The bailout was a rescue of the entire global banking system. The full cost of the 2008 rescue was $29 trillion in emergency support, liquidity programs, asset guarantees, and quantitative easing. This was done to protect a derivatives market worth just $60 trillion at the time. The most disturbing part is what happened after the crisis. The derivatives market was not reduced. It was not dismantled. It was expanded. Regulations were passed to increase reporting, but the structure remained intact. The banks that nearly collapsed the economy became larger and more interconnected than before. Today, the derivatives market is 10 times larger than it was in 2008. 4 banks control almost all US derivative exposure: JPMorgan, Citibank, Goldman Sachs, and Bank of America. Their derivative books are dozens to hundreds of times larger than their capital reserves. If even one of these banks suffers a major loss, the damage will chain through the entire system. No regulator, government, or central bank fully understands the scale of interconnected risk. The models assume stability. The models fail when markets become unstable. The entire structure is now a system where small market movements can cause catastrophic results. Interest rates, currency shocks, sovereign debt stress, or a major default could trigger cascading failures. The system that failed in 2008 was not reformed. It was reinforced and enlarged. To understand why the danger is greater today, we need to look at what the derivatives market is now made of. The largest segment by far is interest rate derivatives, accounting for over $500 trillion in notional value. These are bets on how interest rates will move over time. For over a decade, interest rates were near zero. That stability allowed banks to take enormous derivative positions under the assumption that rates would barely change. This long period of calm created the illusion that the system was safe, but beginning in 2022, that calm ended. Central banks raised interest rates at the fastest pace in 40 years. The Federal Reserve moved from near zero to over 5% in a short period of time. Every derivative tied to interest rates is now exposed to violent price swings. Institutions on the wrong side of these positions are sitting on losses, but most of those losses are not visible. Accounting rules allow banks not to mark these losses to market if they claim the positions are long-term. That means the damage is already happening, just not being openly acknowledged. The same conditions existed in 2007, right before the system broke. The losses were hidden until margin calls made them impossible to ignore. A second major risk comes from credit derivatives, currently about $50 trillion in notional value. These are bets on whether corporations or governments will repay their debts. When credit conditions weaken, the cost of these derivatives rises sharply. Corporate debt has expanded massively since 2018. Companies borrowed at low interest rates, but now they must refinance at much higher rates. This will push weaker companies into default. When defaults rise, credit default swaps trigger payouts. The institutions that sold those swaps will owe money they may not have. This is the AIG problem appearing again, but at a far larger scale. A third layer of risk is tied to currency derivatives, around $100 trillion globally. These depend on exchange rate stability. For decades, the US dollar has held a dominant position as the world's main reserve currency. But this dominance is shifting. Several countries are now conducting trade in their own currencies. China and Russia no longer settle most trade in dollars. Saudi Arabia has accepted yuan for oil. If the global reliance on the dollar weakens, currency markets could become unstable. A rapid shift in currency values would trigger massive losses in currency derivatives. Banks that assume stability would face unexpected and immediate stress. The complexity of these markets makes it impossible to predict exactly how losses will cascade. Derivatives today are often built on top of other derivatives. Some derivatives reference indexes composed of derivative prices themselves. This layering means the system is not just leveraged, it is self-referential. A movement in the underlying asset doesn't just affect one contract, but potentially many layers of contracts stacked on top of it. Models used to price these contracts assume normal market conditions and continuous liquidity. In a crisis, neither assumption holds. Prices gap rather than move gradually, and liquidity disappears exactly when it is needed most. This is how small changes create large consequences. A 1% movement in interest rates or currency values can produce 100% losses in a highly leveraged derivative book. Losses of this scale destroy institutions before they even have time to react. The danger is compounded by concentration. 4 major banks in the United States hold the overwhelming majority of derivative exposure: JPMorgan, Citibank, Goldman Sachs, and Bank of America. Each one is linked to the others through thousands of overlapping contracts. On paper, these positions appear hedged. A gain on one contract offsets a loss on another. But these hedges assume that counterparties remain solvent. The moment one counterparty fails, the hedge breaks. This is how one collapse becomes many. Lehman Brothers demonstrated this dynamic clearly. When Lehman failed, hedge relationships across the financial world evaporated instantly. The institutions that believed they were protected discovered they were fully exposed. A similar structure exists today, but on a much larger scale. The derivative web is deeper, the leverage higher, and the global system more interconnected. A failure anywhere can ripple everywhere within hours. Central clearinghouses were introduced after 2008 to contain risk. The idea was that a centralized entity would guarantee both sides of standardized derivative trades. But most derivatives today are not standardized. They are custom, over-the-counter contracts between institutions. This means the clearinghouses do not cover the majority of risk. Even the clearinghouses themselves are not risk-free. If losses exceed their capital reserves, they can shift the losses to all participating banks. That means even cautious banks can be forced to absorb losses created by reckless ones. The system is constructed in a way where no single institution can fail alone. Failure is contagious by design. The triggers that could set off a cascade are already developing. The most immediate is continued interest rate volatility. If inflation remains high, central banks must keep rates elevated, increasing pressure on derivative positions. If recession begins and rates are cut, the opposite side of the derivatives will lose. Every direction leads to someone being ruined. Stability is the only scenario that prevents crisis, but the world is no longer stable economically, politically, or monetarily. Another major trigger is commercial real estate. Buildings financed at low interest rates now face refinancing at much higher rates. Many properties cannot generate enough income to cover the new debt payments. Defaults in commercial property loans will trigger credit derivative payouts. The institutions required to pay may not have the liquidity to do so. This could initiate the first wave of failures. European banks add another layer of fragility. The collapse of Credit Suisse in 2023 showed how quickly confidence can evaporate. Deutsche Bank, which holds tens of trillions in derivative exposure, has experienced repeated stress signals. Any failure in the European banking system would spread instantly to American institutions through derivative linkages. Pressure is also building in Asia. Japan's government debt is over 260% of GDP, the highest in the developed world. A shift in Japanese bond yields would send shockwaves through global markets. China faces a slow-moving but enormous real estate collapse. As developers default, Chinese banks and insurance companies face mounting losses. Western institutions with derivative exposure to Chinese credit risk will feel those losses as well. The system is interconnected from end to end. A stress event in any region has the potential to trigger cascading failures in every region. The scale of risk is larger than any individual government can manage. The system has grown beyond the capacity for rescue. The question now is, what happens when this system begins to fail? In 2008, the answer was clear. Governments and central banks stepped in with enormous bailouts, guarantees, liquidity programs, and coordinated interventions. The total rescue package amounted to approximately $29 trillion in global support. That scale of intervention was unprecedented, but it worked because the derivatives market was around $60 trillion at the time. The system was enormous, but still small enough to be rescued. Today, the derivatives market is roughly $600 trillion, nearly 10 times larger. The world does not have the financial, political, or monetary capacity to repeat the rescue of 2008. The math no longer works. If even 5% of today's derivatives fail, that equals $30 trillion in losses. That alone exceeds the total cost of the 2008 rescues, and that is just the first wave of losses, not the full cascade. No government has the ability to fund a bailout of that magnitude. The United States is already over $36 trillion in debt. Europe is deeply indebted. Japan is far beyond sustainable debt levels. China's banking system is opaque and already strained. The only tool that exists to fill losses of that size is money printing. Central banks could attempt to create trillions in liquidity to support failing institutions. But printing money at that scale does not solve the problem. It destroys the value of the currency. In 2008 and COVID, printing money caused asset inflation and later consumer inflation. But printing $10–20 trillion to save the derivatives market would trigger currency collapse. People assume central banks can print indefinitely. That is not true. Money printing works only as long as people trust the currency being printed. When trust breaks, printing money accelerates the collapse instead of preventing it. That is the line the world is now dangerously close to crossing. There is also no political support for another banking rescue. In 2008, people were shocked and fearful. They accepted the argument that saving the banks would protect the economy, but the years that followed changed public perception. The bailout saved banks, but ordinary people did not benefit. Wages stagnated, while asset prices skyrocketed. Those who owned assets became wealthier. Those who did not fell behind. The divide widened. This era produced a world of deep political distrust and volatility. Populist movements on both the left and right have replaced institutional respect with institutional skepticism. The phrase "too big to fail" has become synonymous with corruption. Now the system is not only too big to fail, it is too big to save. The next crisis will not allow governments to quietly rescue banks. Any attempt to use public funds to bail out financial institutions will face enormous resistance. Protests would erupt. Governments could fall. Social stability would fracture. This means that, unlike 2008, the next crisis will not be met with overwhelming coordinated support. It will be met with hesitation, political gridlock, fragmentation, and delayed response. The financial system does not survive delayed response. It functions only through confidence. If confidence breaks, the unraveling is fast. Derivatives do not unwind slowly. They are triggered by margin calls, collateral demands, and automatic liquidation. Once the first large failure occurs, the system does not slow down. It accelerates. Bank A fails to meet collateral requirements. Bank B therefore suffers a loss and reduces lending. Bank C then faces a liquidity shortfall and cannot fund overnight obligations. Bank D finds counterparties unwilling to trade and is unable to roll its debt. This is how a single failure becomes systemic failure. The plumbing of the global financial system relies on constant trust. Trust that payments will clear. Trust that counterparties will perform. Trust that the system continues operating tomorrow. When trust disappears, the system stops. The impact goes far beyond financial markets. Banks lend to businesses. Businesses pay employees. Employees buy goods. Goods move through supply chains. Every part of life touches the financial system. If the financial system freezes, everything freezes. Credit cards stop working. Payroll systems fail. ATMs limit withdrawals. Businesses shut down. Unemployment skyrockets. This does not require a full collapse, only a freeze in the interbank lending market. That freeze happened in 2008 and lasted 72 hours. During those 72 hours, the global economy was within inches of irreversible breakdown. In the next crisis, the freeze could last longer because the system is larger and more fragile. Central banks could intervene, but the scale of intervention required would undermine faith in currency itself. That is the double bind. Save the system and destroy the currency. Protect the currency and lose the system. This is not a hypothetical problem. Signs of stress are already visible. In 2023, several mid-sized US banks failed when rising interest rates caused losses in their bond portfolios. These were small failures, but they revealed a key truth. Many institutions are holding losses they are not acknowledging. Those losses scale dramatically when derivatives are included. A small number of institutions hold the vast majority of the risk. If even one of the major derivative holders, JPMorgan, Citibank, Goldman Sachs, or Bank of America, becomes impaired, the rest will face immediate collateral shock. There is no scenario in which one major bank fails alone. The derivative positions are interdependent. The collapse of one is the collapse of all. The danger is systemic, not individual. It is built into the architecture of the modern financial world. The system survived the last 15 years because interest rates were low, volatility was contained, and liquidity was abundant. Those conditions are gone. The margin for error has disappeared. This is not a matter of if the derivative system breaks. It is a matter of when and what triggers it. And the trigger does not need to be dramatic. It could be something as ordinary as a sudden rate adjustment, a major corporate default, a sovereign bond panic, a currency shock, a geopolitical event that disrupts supply chains. Each of those is already possible. Some are already unfolding. The most important thing to understand is that when this crisis begins, it will not look like a slow economic decline. It will look like a sudden break. A system built on continuous confidence does not erode gently. It snaps. The first sign will likely be something that appears contained. A bank reporting unexpected losses. A pension fund requiring emergency liquidity. A clearinghouse announcing increased collateral requirements. These events will seem isolated until they spread. Once one institution cannot meet its obligations, every institution linked to it through derivatives will be forced to reassess its exposure. That reassessment triggers margin calls, demands for collateral, and forced liquidations. The reaction is immediate, not gradual. Banks will begin to restrict lending to one another. This is the interbank lending freeze, the same condition that almost collapsed the global economy in 2008. But because the derivative network is now much larger, the freeze will spread faster and run deeper. Markets will respond violently, stocks will fall, bonds will sell off, and liquidity will evaporate. Prices will gap, not glide. When liquidity disappears, valuation becomes guesswork. This is how financial systems move from stress to panic. Once panic sets in, governments will step in. They will hold emergency meetings. Central banks will open liquidity facilities. They will issue statements telling the public that the system is stable. But stability cannot be restored through words. If central banks try to print money to support the system, the immediate effect will be temporary relief. But the secondary effect will be explosive inflation. Currency confidence is not restored by increasing supply. It is restored by increasing trust. This is where the crisis becomes more than financial. When currency loses credibility, society itself is affected. Savings become uncertain. Prices become unpredictable. Planning becomes impossible. The foundation of economic life dissolves. This is the point where governments face a dilemma with no good options. They can allow insolvent institutions to fail, triggering depression. Or they can print money to prevent failure, triggering inflation and currency devaluation. Either path leads to hardship. In previous crises, governments had room to maneuver. They had lower debt levels. They had public trust. They had time to organize responses. None of those conditions exist today. Government debt is already extreme. Public trust is fractured. Politics are polarized. Stability is thin. These are not conditions under which decisive rescue actions can occur smoothly. The timeline of the collapse will not stretch over years. It will unfold in days or weeks. Derivative failure is mechanical. Once collateral requirements are triggered, the liquidations are automatic. The system is built to unwind itself quickly. Banks will close temporarily to preserve stability. Payment systems will slow. ATM withdrawals will be limited. Wealth will shift not through choice but through structural collapse. The economy will enter what can only be described as forced reset. Pension funds, which rely heavily on derivatives to hedge liabilities, will face the reality that their hedges no longer function. Retirement plans will be revalued downward. Many will disappear entirely. The effects will be generational. This is not alarmism. It is structural mathematics combined with observable conditions. A system built on leverage, opacity, interconnectedness, and continuous confidence cannot survive violent volatility. That volatility is already present. The final escalation will come when people begin to understand that their wealth was not stored in stable form. It was stored in claims on future promises. When those promises fail, the wealth disappears. Real wealth will shift toward tangible, productive, and self-sustaining assets. Not paper claims, but real economic value. This has always been the outcome of monetary disruptions throughout history. The world has seen this pattern many times, but what makes this crisis historically distinct is its global scope. Never before has the entire world financial system been this interconnected. Never before have all major currencies been backed by debt rather than hard assets. Never before has the primary global store of value been built on layered speculation. This is truly the era of financialization, where the claims on wealth have multiplied far beyond the wealth itself. And derivatives are the purest expression of that expansion. Leverage stacked on leverage, promises built on promises. When the unwind comes, it will not be a collapse of one market or one region. It will be a repricing of the entire financial world, a recognition that claims exceed reality, a return to the principle that value must be real to be sustainable. What comes after will depend on how society, governments, and institutions respond. Some nations will restructure. Some will default. Some will reset their currencies. Some will adopt commodity-backed systems. Some will try to digitize control. Individuals will face decisions as well. Those prepared psychologically, strategically, and structurally will endure the transition. Those who assume the system will rescue itself will not. The key truth is simple. The system cannot be bailed out again. It is now too large, too fragile, and too interconnected. The mechanism that saved it once no longer exists. The countdown is already in motion. The triggers are already active. The pressure is already building beneath the surface. The system will hold until the instant it doesn't. And when that moment comes, the change will be sudden, violent, and irreversible.